everyone, and welcome to this AMA. Originally, the plan was to do this in person. Unfortunately, I got I got a booster yesterday, and the situation is not particularly good. So sitting down with a blanket is probably the best solution for me. We're very lucky to have Arthur Gervais, who's going to be monitoring the situation, and he'll dive in if and when I become completely incoherent. He's also the moderator for this session, and so he'll guide the discussion and basically pick up questions that he thinks we should address.
Thank you so much, Christine. Yeah, I hope you recover very quickly. And thanks so much for making it. And yeah, no worries, right? If you feel under the weather, we can take it from here. So don't worry at any point in time.
Thank you. That's good to know.
So we've had a lot of questions coming in. So thank you everyone for sharing these. We've made a list which we'll try to go over today with Christine. And we've broadly separated these questions into different categories. I'll just briefly tell you. So we have regulatory questions, DeFi versus TradFi, current events, and finally the future of DeFi. So roughly 4 categories. And Christine, if you don't mind, we can start with the regulatory questions today.
Please, go ahead.
Very good. So the first question that we have is, so what do you think about the regulatory landscape? So what will it look like? What should it do? How will it change when DeFi becomes more prevalent as a whole? Yeah, thinking about the goal of regulation, so whether to protect, for example, naive investors, or whether to disincentivize bad actors and to avoid systemic risks is definitely a challenge. So how can these goals potentially be achieved, especially in this decentralized and anonymous nature of DeFi?
Thank you for starting out with the most difficult question first. I really appreciate that. Regulation at the moment is a complete mess. And this is because historically regulation has been about imposing controls and organization on corporate forms. So there's legislation, what banks have to do. There's requirements on any kind of person who is in the financial sphere. There are sort of reporting requirements. There's all sorts of other sorts of things. And those are all basically regulations that are based on a firm. If you're thinking about something like DeFi, you don't really have a firm per se. And usually the kind of carrot and stick that regulators use, those kinds of incentives don't necessarily work when something is just made of smart contracts. So the regulators are very worried, and they're trying to think about how to sort of restructure what they do when you're talking about decentralized organizations. The other thing that's very particular about DeFi is one of the ways in which smart contracts are tested and determine whether or not they're reasonable is essentially by allowing people or giving people a profit motive to pursue what are essentially bad contracts or bad platform designs. So it's sort of a feature, not a bug, that basically you can get what is sort of quote unquote known as hacking. These are not really hacks. It's essentially people who are exploiting bad code. In traditional finance, you don't have that exploiting bad code. What you have is regulation based on the different sorts of, or the different financial institutions. And, you know, you have people who come in and audit books and do all sorts of other things. In DeFi, the only way that regulation at the moment happens is essentially by people coming in and making a huge amount of money because the code was buggy. And that sort of very, very different approach really makes regulators quite worried, because if somebody brings down a protocol that was badly designed, typically lots of people are participating in the protocol, and so you get sort of collateral damage. Even though in DeFi world, this is how you basically kick the tires on things, right? You give people a profit motive to find out that something was badly designed. So regulators are extremely worried about that. The other thing that regulators are extremely worried about is the idea that some of these DeFi applications could plug directly into traditional finance. So they're worried about risk spilling over from DeFi applications to traditional finance in ways that regulators haven't thought through. And so a lot of the discussion that we're having at the moment with CBDC and stablecoins and so forth is all around this, oh my gosh, right? It's one thing to have decentralized finances being some strange little island, but the minute it plugs into traditional finance, everyone gets extremely nervous and they want regulation to happen now. So that was sort of a long and rambling response. And I don't know if that hit the questions, but that's sort of how I'm thinking about it.
No, it's an excellent overview. I think that's definitely helpful. We have a follow-up from the audience, I guess, because you mentioned the DeFi attacks. So how is this impacted by smart contract auditing? I guess Jason is wondering how the regulations are impacted by smart contract auditing, or maybe the hacks. I'm not entirely sure, right? But Christine, up to you. How to?
So, I mean, the thing that's really both exciting and scary about decentralized finance is it combines two things. One, it combines a new technology, but also it combines pretty complex economic incentives, right? So yes, you can audit smart contracts and say, yes, it seems to do the things that I want it to do. But if you don't have the economic incentives correct, all hell can break loose. So that says that even though you completely understand the mapping from inputs to outputs, if you don't have the economic model correct, still disastrous things can happen. So auditing in and of itself doesn't eliminate any of these possibly systemic risk events.
Excellent. Thanks so much. So we're continuing in the DeFi regulatory space. I think one of the exciting upcoming decisions or developments that we will see is who of the regulators will feel the most responsible for regulating DeFi, right? So one question that we have gathered from the audience was, given the current landscape of regulation when it comes to DeFi, where do you see the regulatory body of crypto or blockchain? Where do you see them settle? Will it, for example, be the CFTC or the SEC, or maybe somebody else?
Yeah. So that's a very US centric question, Arthur, and I'm kind of shocked that you would come up with a US centric question, but okay. So the US regulatory environment is just nuts. It's super complex and very, very legalistic, right? And so in the US, what I suspect might happen is at some point there's going to be new legislation or new ways of describing decentralized finance And it's going to lead to a, carving out what it makes sense for specific entities to regulate. So there's this idea that Bitcoin is a commodity, in which case CFTC makes perfect sense. But the minute you start talking about things like governance tokens, and you start talking about things where cash flows might accrue to the owners of those instruments, then you're starting to look at something that looks a lot like a security. But I think, given how complex the regulatory environment is, the best outcome would be a new framework that basically is very circumscribed in how it exists or how it interacts with the existing framework. So to some extent, the things that are happening in Europe are a little bit more sensible. They understand that this is a different thing, and you want to make sure that the principles of regulation apply, but you don't want to sort of squeeze something into something it's not.
Very good. So yeah, we're gonna see how each regulation worldwide will apply, and you're right. I mean, in Europe is quite. It's indeed, they try to be a bit more domain specific, so to speak.
Yeah.
Like in Switzerland, for instance, they have like different token standards, clearly defined token standards. So you can have a token that is explicitly not a security token, like a utility token, for instance. But you can also have a security token. So it really, and then you can ask, for example, a lawyer, can you give me a written statement of how would you classify this token? And then you, as an entrepreneur, you have somewhat of a legal ground that you can work with, right? Which is quite helpful. Yeah.
That's much more rational, I think. Yeah.
Right. Very good. So the next question that we have from the list is, how do you think crisis management will work in DeFi? Yeah, I'll just leave it at this for now. There are a few sub questions, but like in general, I feel that's quite a tricky question. It's not, but what do you think about if you hear crisis management?
That is, I would agree with you. That's an incredibly tricky question. The issue is, when we're talking about centralized finance, we know how to measure what a crisis is, right? There are specific metrics that people use, and we kind of all understand where those come from. If you think about something like decentralized finance, and I mean, we haven't discussed flash loans, but those are coming, and I think Arthur's going to cover them. Basically, what they look like at relatively high frequencies are massive spikes and plunges in volume, right? So if I saw a massive spike and plunge in volume in traditional finance, I'd say, uh-oh, let's shut the market down. Something really bad is happening. But in decentralized finance, that's not the case. So where that leads is we don't have really good metrics or an understanding of what constitutes a crisis situation, right? And so the question has to be well defined before regulators and anyone else can interact with it, I'd say.
Yeah, that's a good point. So I have a little bit of experience with liquidation spirals from my research, which could be considered a crisis, right? So if there's a crash in terms of cryptocurrency collateral value, then the liquidators, I mean, we have seen that the liquidators are often selling the collateral right after the liquidation happened. Which then further, I mean, which causes a liquidation spiral.
But the thing that I would push back a little bit on that is we think that somebody sells A and that leads to a change in the price of B and so forth. When we're talking about traditional finance, we view that as being puzzling or a strange thing, because we think that most financial instruments are claims to cash flows, right? In which case, given that you know what the cash flows are, it really doesn't make sense that there would be this massive volatility in prices. Because there's sort of a lack of understanding or how to think about the prices associated with crypto and what their value should be, we think it's a problem because it looks like a problem in traditional finance, but we don't know yet that it is a problem. So this is sort of one of those things that still have to be sorted through. Right?
Indeed, because we don't have, or in most cases, don't have cash flows or balance sheets that represent cash flows for a particular coin that we can report as such. Indeed, yeah, that's a good point. Okay, so we have one last regulatory question. It's again, apologies, quite US-centric in that way. So one of our students asked, so he said that Gary Gensler is signaling that proof of stake assets can be considered securities, to be a security. If so, Ether, which just beautifully performed a nearly flawless merge, can be considered as a security rather than a commodity. So what is your opinion on this, and what implications does this have for Ether or any proof of stake assets as a whole, if they may be reclassified?
So I'm not a lawyer. It's just way too complex. I think this sort of goes back to the idea that the US regulatory environment is intensely complex. It's pretty clear that even though under proof of stake, you're using this asset as collateral, essentially, it doesn't necessarily flow from that, I think, that it performs all the functions that we think that, say, equities or other securities that we use as collateral are. So I think a lot of what you hear from regulators, and this is without having, spoken to them directly about it, is their sort of positioning, right? Regulators like to have as broad a regulatory span as possible. And so as part of a negotiation, just looking at the sort of the statements that are made, they try and basically say that their institution has the biggest possible footprint in terms of regulation, and then negotiation, at some point, it sort of drifts away, or it becomes much more circumscribed. Yeah.
Okay. So speaking of the merge, so there's been a lot of news around the merge, right? Could you comment maybe on the implications? What do you think this will change for DeFi, or specifically on the financial aspects of DeFi? I mean, does proof of stake change DeFi after proof of work?
I think in terms of the economics, no, right? I mean, obviously there's the carbon footprint of proof of work. There's some issues about market power with proof of work. So moving to proof of stake will sort of change those. But I think in terms of, is this going to make DeFi more or less vibrant? I would say not. I mean, I don't think it's going to have those kinds of fundamental changes. Yeah.
Right. Also, yeah, it's quite important, I think, to spell this out explicitly, right? Because there might be the belief that it does change fundamentally some of the application logic, but it doesn't necessarily. And thank you for spelling this out so clearly. So regarding the going back to more DeFi versus TradFi, which you also mentioned earlier already, that the traditional finance may somehow be alert if CeFi and DeFi get too much entangled, right?
Yeah.
So what do you think do DeFi and traditional finance have in common? So what are the unique application areas of DeFi where they will never be together or they will be merged, right? I mean, what is your feeling on the synergies or also on the conflicts of these two technologies?
Okay, so as a consumer, I really don't care what the corporate form is behind whoever's producing whatever it is that I need, right? I don't care if it's a big firm, a small firm, or how it's organized, if it's a collective, a nudist colony. I just don't care. The only thing that I really sort of look at is this doing what I want it to do? Is this helping me? Is this helping my finances? So, so in terms of DeFi and traditional finance, consumer adoption should only be affected by how sort of user-friendly these systems are. At the moment, traditional finance is way more user-friendly, and that's just because they want to get the retail investors in, and they go to a huge amount of effort to sort of suck people in and make it easy for them. So that's sort of one thing. The other thing that is potentially completely revolutionary about DeFi is it allows completely different bundling of financial services. So for example, payments and lending, we know those as a bank. Those two things exist in the same institution. In DeFi, it's not clear that those two things exist in the same protocol. They can exist in separate protocols. And then we start to look at something that's actually a lot different from the consumer point of view. It's a lot different in terms of the pricing of what the underlying things are, the pricing of, say, payments versus loans, and also the sort of efficiencies for consumers. Right. And so I think those are two things to bear in mind.
Just a fun side note, I think Apple had an advertisement a few weeks ago I saw where they claimed, oh, now you can do atomic transactions in traditional finance with some of their apps. Like, the atomic transactions that you do in DeFi are standard, right? And they're one of the key features. And maybe some of this atomicity can be brought over to CeFi because there are indeed quite some advantages in having these features.
Yeah. But this is, I mean, that's not a technological change. It's like a conceptual change, right?
Right.
They just, oh, we can do that. Okay, let's do it. Yeah. And this is sort of economic innovation, I guess. Yeah.
Yeah, indeed. Would it somehow reduce the risk of arbitrage if this were possible among like different exchanges in traditional finance?
Ask that question in a different way.
So if we could have atomic transactions in the traditional finance domain, like for instance, I could say I want to make this transaction on the New York Stock Exchange and I want to make this other transactions on the London Stock Exchange, and they should both either happen or fail collectively.
Yeah.
So would this be some advantage or change to the traditional finance?
So traditional finance has a lot of sort of contingent orders, right? So one, you can have things that are, for example, you can have fill or kill orders, for example, on traditional exchanges. They either happen, all of them, or not at all. If you're in a situation where it's really important that or that users have a lot of value to have two things being executed at the same time, typically what you're going to see is you're going to see either a derivative contract that basically does that within the span of the derivative, or you're going to see these two things trading on the same location. So traditionally, what TradFi has done is basically tried to, if there's a huge benefit to have things being done simultaneously, is to redesign either the marketplace, the contracts that are traded, just so that that happens. They don't call it atomic, but that's what they're doing, right?
Okay, so in effect, it's already happening in some regards, right?
Yeah, I mean, if there's a huge benefit to doing it, well, you're gonna figure out how Goldman Sachs is gonna figure out how to do it, right?
Perfect. So the next question we have is about asset classes. So we mentioned earlier that stocks and securities, they have an underlying mechanism, right? A set of the rules surrounding it as well over the last decades. But how would major financial institutions fully consider cryptocurrencies as an asset class? And maybe before answering that question, maybe you can also define what you would consider an asset class, or what is the definition of an asset class?
So asset classes come from the idea that people are worried about risks across states and time, and they want to get some sort of hedge or payoff in different states and different times in the future. So this whole idea is that people are risk averse, and they want to make sure that they have enough to consume at different states in the future, right? So anything that allows you to move value across time like that, I would say is an asset or an asset class. Different asset classes have, so I would say that that ability to move is an asset. What is an asset class? An asset class is basically an asset that has roughly the same set of characteristics. So fixed income, what is that? It's predictable cash flows. There can be some variability, but not that much. Compared to equities, what do you get? You get a percentage of the operational cash flows and so forth, right? So why would a cryptocurrency be viewed as an asset class? Well, what you do is you take the returns of the cryptocurrencies, so how much it changes over time, and basically say, okay, is it correlated, or does it perfectly replicate the payoffs of any other instrument out there? And it turns out that when you look at things like crypto, it's like a new asset class in the sense that, yeah, it's correlated with stuff, but not perfectly. So what that says is it says that in some states and in some situations, if you hold crypto, you get a payoff that you don't get for other instruments.
Very good. We have a direct follow-up question from the audience about stablecoins. Are they an asset class?
So yes, you can view a stablecoin as being an asset class. What does it do? Well, if I have $1 today, in every single state tomorrow, if I have a stablecoin and it is truly stable, I'm going to have $1 tomorrow, right? So it's a particular type of asset that doesn't have state contingent payoffs. And basically, if you have it today, you got it tomorrow.
Okay. Now, an asset, the definition of an asset class, as you laid out, interestingly, doesn't introduce any like due diligence or any other requirements, right? It's solely on the property of being somewhat, but not fully correlated to other asset classes, right?
Yeah,
or to
exactly.
other assets, right?
Exactly.
So I suppose, because we have this question of how would crypto be integrated into the traditional asset bracket from a traditional finance perspective. And I suppose the asset class question itself isn't enough to answer this, because you also would need to have these due diligence or other possible parameters that these traditional investors are considering when introducing an asset class, right?
But so, I mean, we've had a lot of excitement around cryptocurrencies. So in particular, the futures contracts. So what are they? Those are basically cash settled, and they're based on, I mean, you know, they're traditional futures contracts, so they allow you to get a levered position in whatever the return is of the underlying. So Bitcoin was the first one. And there's something, the Bitcoin reference rate and the payoffs are conditional on that. So you could, you know, in different countries, so outside the US, it's not unusual for retail investors to have actual intermediated access to cryptocurrencies. So for example, in Canada, you can have cryptocurrencies in your portfolio and you can get it through your bank. In Sweden, the NASDAQ, which actually owns the stock exchange, basically offers a crypto index product. So it's only in the US where there hasn't been a lot of there's not a lot of access for consumers. And a lot of this has to do with the US regulatory authorities are worried about getting accurate prices, I guess, around cryptocurrencies. Yeah.
And as we see these traditional finance or institutional investors getting more and more into crypto, right? We also see more legacy or traditional financial players get into crypto. They have some product offering. You can now buy Bitcoins in your trader, in your broker app on your phone. So do you see this essentially as increased like new intermediaries, new authorities, centrally governed bodies that may remove some of the benefits that DeFi was supposed to bring for its users?
You know, you could argue that there's a natural state in which intermediaries move in and make it easy for people to do things. And this seems to be what's happening in DeFi. Just because consumers want to have an easy interface, they want to know that they're not quite sure about the technology, they don't trust it. So having somebody who has a brand name as a corporate entity, their retail investors are more comfortable going through those kinds of access points. The thing that's very or that's worthwhile noting is, in order to have really big institutional uptake of decentralized finance and cryptocurrencies in general, you need to have infrastructure. And the infrastructure has to work with institutions, which, as we discussed before, are regulated in a particular way. So an institution is not going to have a wallet or even a cold wallet if there's only one person who can sign onto it. That's just not going to work for an institution. Institutions are going to want to be able to buy and sell. They're going to want custody. They're going to want to be able to short. They want to have all sorts of their usual kind of things that they need in order to trade. They're going to need that in order to in order for there to be uptake, right? And still, we seem to be, DeFi and trading in DeFi is sort of exploding or has exploded, but still some of that institutional backbone that people need in order for institutions to trade is still not 100% there.
That's my dear audience, that's a very important comment. So all your entrepreneurs out there, listen carefully to Christine, right? This is still needed. We need this infrastructure. Very good. So one more question on the DeFi versus CeFi category today. So it's maybe a bit also like a forward-looking question, but will the NASDAQ or the New York Stock Exchange be affected by crypto securities trading? And what has been the effect so far, if you could measure any?
I mean, I think the biggest way in which the traditional legacy exchanges are going to be affected is by adapting some of the models that we're seeing in DeFi. I mean, I guess you're going to be doing sort of Uniswap and AMMs, right? So traditional exchanges maybe want to have products that look a lot like AMMs. And the reason why they want to do that is because you have institutional investors who have really big portfolios. So essentially, they're natural liquidity providers. They want to have a sort of safe and easy way of providing liquidity, get a little bit of return on that. And yeah, they might lose a little bit because of the sort of trading or rebalancing in states when they don't want it. But, this might be attractive for institutional investors. And so I think you're going to see you're going to see traditional legacy exchanges sort of trying to incorporate this stuff. I mean, so I guess Swarm, which is BaFin regulated, is an AMM, right? And so this is sort of a step towards traditional finance incorporating the new ideas from DeFi.
And that's such a huge thank you, for all the DeFi communities that AMMs are then present in traditional finance. And yeah, these synergies, they are so beautiful, right? This is really where innovation across domains occur. And I mean,
yeah,
it's really I mean, as a researcher, that's what I love, right? If I would have invented AMMs, which I've not, but then like I would be very proud of this like transcendence across domains.
Yeah, it's very powerful.
Yeah. Very good. So the current events, there are two questions regarding current events in DeFi that our students are quite keen on to know your opinion. The first one is about the crypto bank Celsius network. I'm not sure if you heard of it. It recently filed for bankruptcy protection in July this year. So they're now trying to rebuild their strategy that will focus on custody of crypto assets, like one of the infrastructure components you mentioned that are necessary for the space. So what are your thoughts on the strategy and how do you think they will perform?
That sounds a lot suspiciously like investment advice. And no, that's not something that I have insight into. I think one thing that was interesting about Celsius is, we started out at the beginning talking about there's these sort of technological innovations, but then there's also economic innovations. And you have to have both of them working really well, or you run into trouble. And I think Celsius might be an example where some of the economic innovations didn't quite work the way everyone or thought that they should. And so maybe pivoting a business model is not a bad idea. No.
And have you maybe also heard about other hacks or in general, like what do you like for example, I think there was the Wintermute hack where some of these traditional providers lost their assets and I guess it's I guess it's tricky to react. I mean, it depends always, obviously, on the business, on how they can sustain operations. Yeah.
But once again, I mean, sort of going back to this idea of hacking, this is sort of the way in which decentralized finance polices and regulates financial institutions. So if you think about a traditional bank, what happens? Well, there's the FDIC, and if they think that the balance sheet doesn't look good, they'll walk in on Friday afternoon and they'll shut the bank down, and they'll shuffle the deposits around, and they'll start it up again on Monday morning with a slightly new balance sheet. So the way DeFi does that, because there's no regulatory entity that is, in charge, the way DeFi does that is basically by having one person who's essentially a freelance FDIC guy who essentially is quote unquote hacking. Yeah.
Yeah, thank you, Christine. This was precisely what I was looking for. You helped quite well there. Thanks. So one further follow-up question might be, like, to what degree is DeFi disproportionately affected by such events, right? Such hacks. But yeah, you explained it in traditional finance. You can pause, sleep over it a night or two, and then restart on next week. I think that was quite a good example in that regard. Okay. So the last question on the current events is, so what do you think about the Archegos blow up and the recent increase in margin requirements? I'm not sure if you followed up the Archegos blow up. This was a family office apparently, and they I don't know the very much details, but I think they had about 20 billion in assets under management, and made some poor investment decisions, I suppose, which then affected banks worldwide. Some more and some less that reacted early on.
Yeah. So one of the sort of, I guess, debates, or the thing that people are looking at in terms of DeFi, is whether or not some of the protocols can use capital more efficiently than you use in traditional finance. And so in traditional finance, there are a couple of things that go on. There's people who always have to put margin down. You have to essentially put down collateral. Two, because it's a very small world and there's a lot of information sloshing around, what you frequently see is essentially runs, because people want to be the first ones to get their asset out, right? So in DeFi, if you have positions that are over collateralized, which is typically the case, unless you have some sort of time lock or something, you're not gonna, you're not gonna get runs in the same way that you get in traditional finance, right? But the capital is going to be used less efficiently because you have to put so much down. And I don't think that anyone has sort of figured out exactly what the correct balance is between these two things. To some extent, you can argue that on the one hand, you have more efficient use of capital in traditional finance, but then you also have a higher susceptibility to runs. In decentralized finance, because you're not relying on trust or anything like this, you basically have less efficient use of capital, but you don't have strategic runs in quite the same way that you do in traditional finance. And this is still something that's being sorted through and shaking out. Right?
Should we introduce like circuit breakers in DeFi? Like, for instance, if suddenly the volume goes beyond a certain limit, or the slippage becomes too high, or whatever. I mean, there's already DeFi protocols that have these kill switches, but we don't have like circuit breakers as the traditional stock exchanges have, right?
So one of the reasons why traditional stock exchanges have circuit breakers is because a huge percentage of liquidity provided on traditional exchanges is provided by what are known as HFTs, or high frequency traders. And basically, if something is going on and they're not quite sure what it is, what do? They withdraw their liquidity. The minute you withdraw liquidity, suddenly you're going to get massive price dislocations. And so, just because of this sort of the complex interplay of the people who are demanding and supplying liquidity, you basically have this, oh, let's just slap a circuit breaker on. So where I want to go with this is just to sort of caution you that a lot of the things that we're used to in traditional finance essentially are coming about because it's sort of traditional financial markets are basically Frankensteins. So there was a problem, so somebody added a regulation. That regulation then caused another problem, so somebody added something else on top of it. And so, you've got to be, it's sometimes difficult to know what's driving what and what's a good idea and what is just solving a problem that something else initiated.
Perfect. Very good. Then let's move forward to the future of DeFi. We have quite a few questions about how the future is going to look like. So obviously, it's hard to predict what's going to happen. But in your lecture, we learned how money needs to have 3 characteristics, right? So it needs to be a store of value,
Yeah.
a unit of account, and also a medium of exchange.
Yeah.
So in DeFi, we have this concern of that stability, or this concern of stability, and there's been various attempts to solve this somewhat, right? I mean, we mentioned stablecoins, but do you think that stability will always be an issue in DeFi until somewhat the majority of the population is able to have confidence in DeFi?
Sorry, I just didn't understand the question. Could you?
Yeah, right. I think we're trying to somewhat look a bit into the future, and we observe that at the moment in DeFi, stability is a concern. Whether this is now, and I would like to keep this open, whether this is now about price or about fees or about attacks, right?
Yeah.
There's so much volatility on different levels, right?
Yeah.
Do you think that this stability concern or this volatility on these different dimensions will remain, or will this somewhat be alleviated by wider adoption or by more professional institutions, etc.?
If people find some aspect of DeFi just too scary because it's too volatile, they'll move away from it, and basically that will just dry up and disappear. A lot of the issues around volatility, especially when it comes to things like payments, aren't really that much of an issue because people typically aren't using stable coins as bank accounts so much as using stable coins. You roll into a stable coin, you transfer it to somebody else, and they roll out of it, right? So the minute you do that, you're basically exposed over a very, very, there might be volatility, there might be whatever going on, but it's just over such a short horizon that, it still works, right?
Very good. And regarding this, does it still work, right? What about stablecoins? So if we have these reserve-based stablecoins in DeFi, we have algorithmic-based stablecoins that sometimes work, sometimes do not work. We have CBDC, we have just fiat, just cash, right? Do you think a financial system can have 2 or 3 types of stable currencies circulating for long-term stability?
Absolutely, yeah. I mean, so if you think about modern economies, they all have multiple forms of payments that are circulating at the same time, and we're all comfortable with it. If you think about things like, so algorithmic stablecoins, which have obviously been in the news because of Terra, going back in time, the Bank of England essentially was running a algorithmic stablecoin, right? They were basically saying, okay, this is what the value of the pound is, and you know what? This is what it is. And George Soros, who was the guy that, quote unquote, broke the Bank of England, sort of said, I don't think so. And that just led essentially to the pound having to free float, right? So that's sort of one example. In terms of, other types of stable coins that we have floating around in traditional finance, when you pay with something through, say, your Visa card, you're actually using private money that is issued by the bank to essentially pay for whatever it is that you want to buy. We're not really worried about banks issuing their own private money or essentially stable coins because they're banks and they're regulated. Everything's fine. What can go wrong? So this is an example of, another form of money that sits side by side with physical tokenized fiat money. So traditional finance, if you kind of dig into it a little bit, it has a lot of pretty wild innovations around money, but we're just so used to using them that we think it's all kind of normal, and we don't sort of worry about, we don't worry about the stability of these things because we think the government will take care of us at some point.
Very good. So in the lectures, you mentioned that retail investors tend to build inefficient portfolios.
Yeah.
And the investment decisions they make would generally be deemed unwise by a professional.
Yeah.
So to what extent do you believe that the current DeFi landscape is shaped by unwise decisions of, for instance, retail investors?
So sadly, the academic literature basically says that somebody who is most likely to have crypto in their portfolio are young, male, and willing to take risks. So what that tells you is it tells you that the market skews in one particular direction, and it skews essentially in a direction of people who are willing to hold things even if there doesn't seem to be a sort of sensible cash flow thing behind it. So I think probably a lot of the price appreciation that we've seen in decentralized finance, sort of, people asking, well, what's it worth? What's the value? This is just for people who like making risky bets. And so that's driven a lot of the price appreciation. At some point, you're going to get people who basically say, oh, hey, if I have a public computing resource, I can write smart contracts on it. I can build some new entrepreneurial thing that's fantastic. At some point, that is going to be a source of fundamental value, and it is going to, people should and will invest in it. But I think there is a lot of what is sort of known as speculation currently in the crypto world.
Indeed, right. What I also find personally quite exciting is this notion of suboptimality in DeFi, because a lot of actions that you can take in DeFi, for example, if you do a swap on Uniswap or on SushiSwap, it might not be optimal in a sense because you're not using like a router or you're not doing arbitrage. So you're leaving kind of money on the table by taking simple actions, right?
Yeah. But the question is, I mean, so this actually speaks to your research. I mean, so how big is that? I mean, so we think that small frictions, but how much is that?
Right. I mean, we haven't quantified it, but it's definitely, yeah, I mean, I wouldn't know. I would probably need to quantify it in terms of percentage of the volume of the overall trading volume, I suppose. But yeah, we haven't done this, but it isn't small. I'm sorry that I can't quantify it. But I can give one example. So Compound and Aave are two lending platforms. They do have slightly different curves for borrowers and lenders to determine the interest rates. Yeah. So I believe that Aave is going up a bit later with the interests, depending on the utilization. but then it's going up much steeper. So there's some sort of an arbitrage that can be done between these two lending platforms. But what's more interesting is if you are a whale in the sense of some wealthy individual or institution, then it may make rational sense to remove some of your liquidity in the lending platform to earn a higher yield on what you have in there.
Yeah.
And we've made the math, and on some positions, this made a substantial difference. So they were like, I mean, it literally didn't make any sense to add additional money. You had to remove money to make a higher yield on the overall amount, which is one possible suboptimality case. Yeah,
that's absolutely fascinating. I think the other thing that your comments bring to the fore is that even though decentralized finance is decentralized, it doesn't mean that they're not big players. Right. And there's an exercise of market power, I guess.
Especially in the high frequency trading domain, we've seen more and more bigger players coming in the recent months.
So my understanding is that a lot of the traditional high frequency trading firms that live in equity markets have moved into crypto. I mean, it's the same technology. They make money. They don't hold. And they're very, very happy to do it. Yeah.
Very cool. All right, so the next question from the audience. So we have access to traditional financial services, and they continue to be limited in certain parts of the world, especially in developing economies. We've also often observed innovation in the financial service sector originating from more mature markets than diffusing to less mature markets. So do you expect these developing economies to somewhat leapfrog and directly adopt DeFi? Or do you think they will just continue in the traditional finance direction?
I think, this is all just obviously wildly speculative because the future hasn't happened yet. But one of the benefits of coming from a low income or underdeveloped country is you can start and do things from the ground up. So in the US, everything works pretty well in terms of the financial system. And so there's not a huge incentive for people to innovate. But compare that to a country where the financial system doesn't work well, then there are huge incentives to innovate and to do something really clever and new. And so I think you're going to see the countries that are less developed leaping forward and basically overtaking what's happening in the US, just because they have a much bigger incentive to do it and they can organize from the ground up. If you think about countries, for example, like China, if you think about the stunning sophistication of their payment technologies, their experiments now with the digital yuan, they are just way, way ahead of the US. And that's because they started out from sort of a relatively less okay place. And so there was a huge incentive to push forward, and everyone adopted sort of cool new payment methods. Bang. You can think about, M-Pesa, for example, which is sort of the example that everyone drags out, or even Bcash in Bangladesh. This is like super sophisticated, low cost, widely adopted, and that's just because there wasn't a good solution. And so, a new thing could leapfrog. So I think that's going to happen more and more. Yeah.
Yeah, that's fascinating. I mean, it's kind of analogous to the to the innovator's dilemma, where if a company is too successful, reaches saturation in its markets, then a newcomer has much easier chance to get into a new market that's maybe even bigger or can absorb the old market, right? So, but we're talking here about like nationwide scale markets or infrastructures. So it's quite astonishing how yeah, I mean, I really like this question of the audience, so thank you, yeah, to the audience as well. It's really to see these dynamics or understand these dynamics and how more mature markets or less mature markets may develop differently. And speaking of mature markets, one important component of such markets are KYC AML regulations or laws, and also their enforcements naturally.
Yeah.
So what do we do about KYC AML in DeFi, or what is their role? And would these be necessary for DeFi really to grow significantly, to gain more confidence in the space?
Yeah, I think so. I mean, this is obviously something that's generating a lot of regulatory interest, because large banks, and so, I mean, governments are really, really worried about terrorist financing. They're worried about crime and so forth. And so I guess one of the pushes in DeFi is to figure out whether or not it's possible to put some sort of restrictions on the on-ramps, either on or off ramps, just to make sure that, you know the source of the funds and what's going on. And this is going to be a complete sore point. And I think it's something that the DeFi community has to sort out. Yeah.
The on and off ramps are already being quite scrutinized, I'd say, right? We can,
Yeah.
With the travel rule and
Yeah,
and
exactly.
different good point. And final question from the list that we prepared. We may look into a few more questions afterwards, but the list here, the final question here is about too big to fail. So is DeFi already too big to fail?
No, it's pretty small. I mean, I think if you compare the entire DeFi ecosystem, I haven't actually run the numbers, but it's smaller than Jeff Bezos, right? As an individual.
Right.
I think it's completely innovative, and regulators want to make sure that they engage now before it gets bigger. And so, yeah, that would be my perspective.
Right. Which implies that the next month's going to be interesting. We have a bright future, everyone. So I will check the Zoom chat regarding a few more questions. If you're fine, Christine. Also, I mean, do not hesitate to tell us if it's been too long for you. Yeah.
I'm starting to fade a little bit, but when I start
okay.
getting really incoherent, we can.
Right. So let's take two more questions or so, quick ones. So here there's one regarding blockchain or no blockchain. So can we have DeFi without blockchain?
I don't even know how to address that. What do you think, Arthur?
It depends on how we define blockchain. There may be decentralized blockchains or permissioned ledgers. Because a blockchain at the end of the day is just a database.
Yeah.
So if this database is running in a bank, we can call it a blockchain. If there's somewhat some hashes that kind of make sure that the integrity is protected and so on.
Yeah.
Right.
So we're seeing some experiments with groups of banks that are essentially sharing information, but hashed versions of information, so they can say that it's there without actually, violating privacy and so forth. So we're seeing quite a bit of that. And I think it's just this efficiency gain of having a common ledger. They love it. Banks love it.
Right, the need to, does it actually reduce collateral requirements if you have a common ledger? Probably not, no?
I mean, so the changing the collateral requirements usually comes about whether or not you have a gross or net settlement system, which may or may not be related to blockchain or common ledger. But if you there are a non-trivial amount, sharing information among banks conceptually is a super simple thing. In reality, it's hideously complex. There are all these stories about people who actually make a huge amount of money because they can program in COBOL, right? And a lot of the legacy bank systems, their data management systems, are just, absolutely gothic. And so moving to something where information can be moved, sorted, standardized is a huge efficiency gain.
Right. Yeah, I was thinking about this, the interbank payments and also cross-continent payments when you don't have a a common central bank, right? Because then you need to have all sorts of collateral on various sites. But it's true, the ledger itself shouldn't, if there's just one single ledger, it wouldn't necessarily alleviate or reduce this collateral per se. Right. Yeah. Is there anything else you wanted to maybe to address or to comment on? I don't want to torture you much longer. Yeah.
I can't think. I mean, I think the only thing that I would say is, the technology is new and it's really exciting. But there's much more to decentralized finance than the technology. And that's the economic incentives and how they interact with the technology. So especially for people who want to innovate or sort of work in this space, you've really got to make sure that you're understanding what the economic incentives are, just to sort of figure out how things work. And so I just reiterate that it's very, very, very important to sort of understand that side of things. Yeah.
Thank you so much, Christine, for still making it today after having a booster shot yesterday. That must be very draining. So very much appreciated. Yeah. Yeah. Thank you so much. Wish you all the best for a healthy and speedy recovery. Yeah.
Thank you. Bye.
Bye.